let's focus on a couple of stocks then. We have Feroze who joins us to help us detail Anand Rathi Wealth numbers. Hi, Feroze. Good morning and good to see you as always. Feroze, the numbers look quite good. The guidance you've laid out, well, you've smacked it in the first half of the year itself. So you put out a revised guidance. Give us a few details. What were the primary as well as the secondary issuances of structured products in this quarter? And also, if you could tell us, have the spreads moved?
Yes, Nigel. Firstly, yes, we've revised our guidance from 280 crores to 295 crores for PAT, and we've increased our guidance of the AUM number from 7,200. 72,000 is what we had said, but we are already at 75,000, so we have revised that AUM number to 80,000, and the revenue numbers have moved up from 910 to 980. That's our current guidance. Point one. Point two, I don't think we look at issuances on structured products so microscopically because these are all bottom-up numbers. If anyone is a shareholder, the way he has to look at it is these are portfolios created for 10,990 families. The culmination of the portfolio rebalancing and balancing activity results in whatever is my issuance. So we don't go what revenue I want to do and what structured product will I sell. I go bottom up because clients have earned money 20, 30, 40 years of hard-earned savings. So whatever is their return risk objective, that culminates to whatever is the allocation between the three products only which we do out of the 16 wealth management outfits can sell, which is debt mutual funds, equity mutual funds, and structured products. Now, if I have to give you some color in terms of the potential, ideally on April 1st, 2023, our structured product allocation as a percentage of the total assets was 29%. Now it has come down to 23, 24%, which implies that 5% realignment opportunity exists because of higher mark-to-market in the equities side. So 5% of 7,000 crores, 75,000 crores is the potential of structured product net sale over the next few months when we try and realign people's portfolio back to where it started from.
Feroze, thanks for that. So what you've essentially done at the end of H1 is that you've revised upwards your AUM guidance, your top line guidance, as well as PAT guidance. And we believe as far as the top line and PAT is concerned, you've already met close to 50% of your revised guidance that you have for the entire year. Now, number one, the main question here is net inflows, have actually gone and seen quite a bit of a dip on a sequential basis. Is this a one-off phenomenon according to you? And which asset class actually saw the dip? Is it on the back of the fact that there are actually a few open-ended schemes that were launched in the quarter gone by? Is it because of that? And how are inflows expected to pan out for the rest of FY25? What's the ground level feedback?
So firstly, the net, you're absolutely right. Sequentially, between the last quarter, same year, equity mutual funds have had a lesser net flow. See, what the problem is, since I'm not in the business of selling a product, I'm in this business of managing people's portfolios. So what happens is, if I have to realign money from equity mutual funds, structured products to equity mutual funds, the flows could be larger there. So I'm not just a provider wherever there is be at the right time at the right place is not the strategy of Anand Rathi Wealth. So what's going to happen is, if I tomorrow reallocate money from structured product to equity mutual funds to structured products, which is what realigning the portfolio is all about. When markets give you a lot of return, you'll have to realign. So you might see an outflow from equity mutual fund into structured product. That doesn't imply that my clients have stopped buying equity mutual funds. It's a realignment. Point one. Point two, 5,700 crores. We had an aspiration 5 years back. Our total net flow was just 400 crores for the full year. We had this aspiration of getting to 1,000 crores per month, which we are almost close to. Unfortunately, we have not got to 6,000. 6,000 is what we had an internal target of. We got to 5,700. Some God's help, some markets help, the positive sentiment. But what I think your viewers should notice, which I'm sure will get unnoticed, is how does Anand Rathi Wealth Limited perform in the bad sentiment of the market? The worst quarter from a market standpoint after we've got listed 12 quarters back was the first quarter of FY23, where Nifty fell 10%. That quarter, sequentially, we grew 33% year on year.
Interesting. You made this point before as well, Feroze. So, it appears you're reassuring your investors out there that even in a bad market, you can continue to outperform. We get that. Give us a few details then. What's the blended yield in the past quarter? How do you see this number pan out going ahead?
See, now if you have 75,000 crores, if we are looking at 980, the yield is 1.2, 1.3 on the current assets. Yields are on weighted average assets, and AUM is measured as a picture, and yield is measured as a movie. So 75,000 crore AUM is the 30th September number. So if you look at the yields which we make on the three products which we sell for the last 12 years, we have not launched anything new, and the same boring things HNI buy, unlike the popular belief that HNI needs more interesting, innovative products, which is not the case. He needs a better Sharpe ratio. That's what we try to deliver. So coming back to your point, if you look at the yield, long-term yield, you will get 1.2, 1.3. What we make on our mutual fund model portfolio is 1.09% post-GST. The yield of structured products calculated backwards at maturity is 1.17 for the 3,000 odd structured products which we have done, and out of which 1,500 have matured, which is one of the largest maturities of our sister company, which is Anand Rathi Global Finance. I don't think most of the NBFCs wouldn't have had that kind of maturities paid on time every single time.
Feroze on the front foot today, smacking it out of the park. Feroze, I can feel the confidence in your tone as well. Since you spoke about the three categories, the breakup of your AUM, debt MF as a percentage of the total mix, that was 9%, has come down to around 6%. How do you see this number panning out?
There are two parts to it. We generally don't like to take assets. We try and keep a very strong bouncer at the gate itself. We don't bring short-term assets at all. If a person has intergenerational wealth, which is what most ultra HNIs and HNIs have, if somebody's got 20 crores, in the next 20 years, if he grew at 15%, 14%, he can have 150 crores. So he's not going to be, or she's not going to be able to spend it. So the reason why our debt proportions are small is because we believe that if the money is intergenerational, debt is almost like poison to the portfolio because it will not beat inflation. And this whole market timing of interest rates coming down, we don't buy that theory because the long end of the yield curve has not gone up. So if RBI reduces interest rates, it doesn't imply that the long end of the yield curve will also come down because it's not gone up. So yesterday 6.89 is the 10-year paper and 6.56 is the 3-month paper. This is the flattest yield curve India has ever seen, at least after I've started working in 2004. So I don't think this whole argument that debt will make huge capital gains if interest rates are reduced by RBI, because RBI tinkers with the short end of the yield curve. And so we are not bullish on any opportunity on the debt side either. And anyways, for long-term monies, debt will not be able to beat, especially given the post-tax returns, will not be able to beat inflation. And anybody who's got monies for the next 3 generations should not be wasting time in debt.
Feroze, another question, and slightly more from a regulatory point of view, and we want your view on that. There have been significant clampdowns as far as F&O trading is concerned, and there have also been a reduction in the number of expiries that each exchange is allowed to have. Do you see any second derivative impact, number one, on your business, number two, any impact on the structured products, and what is the kind of feedback that you're getting in from customers, especially given the fact that they will now face fewer products to trade in terms of expiries?
Yes, thank you for that question, but you've opened a little larger canvas. So let me try and explain that. Point one, I think that's the best thing regulator could have done. Because just go in weekly expiries in India started in February 19. That's close to 5 years plus. Just a year back, we had very few expiries. Now, because of the exchanges wanting expiries on every day, a person could have quit his job and had with the same 4 lakh margin could have done 1, 2, 3. Monday ko ek kaam hai, usko Friday tak kaam hai, and weekend he chills. So he was gambling with his hard-earned monies, and it could have become a full-time job because every day he had an expiry, and the same amount could have been used 5 times in the same week. So expiries converging or elimination is the greatest thing. Most retail participants or most even HNI participants don't even understand option Greeks, let alone Black-Scholes pricing model. They don't know what's delta, gamma, vega, theta, rho. The second order derivative of is also something which a treasury guy will know, which is Vera and Veta. These 7 items, without knowing this, if somebody is trading, he's only speculating, and and institutions have done 3-year courses. My colleague who has been at IIT Cambridge, who has done a derivative course and then sits on the terminal, he will definitely have an advantage over 99% of the retail traders. So as a parent, a regulator has to protect the interest, and I think this will be very good. From a structure product, collateral damage or collateral benefit, I think it will have a huge collateral benefit because futures volumes don't get impacted.
Thank you so much, Feroze. Out of time, for this short interview, we'll get you once again to discuss this particular development in detail.